All right, today we're going to tackle something that hits all of us, whether we're planning a trip or just watching the global news. Currency exchange rates. You know, how they really work. Let's break it all down.
Have you ever looked at the price of a dollar and wondered, why is it different today than it was yesterday? You've seen it if you've ever bought something from another country online, right? So what's really going on behind those ever-changing numbers? Let's find out.
Okay, first things first, before we can get into the complicated stuff, we need to get a really solid handle on the basics. So what exactly is an exchange rate?
Well, in the simplest terms, the nominal exchange rate is just a price tag. It tells you exactly how much of your own currency you need to buy one single unit of a foreign currency. It's a straight-up currency-for-currency trade. So, for example, if you see that $1 equals 3.65 Israeli shekels, well, that's it. That number is just giving you a snapshot, a direct comparison of their values right at that particular moment in time. But here's where it gets interesting. That number, it's almost never the same for long. It's always moving, always shifting in one of two basic directions.
And these movements have names, of course. When your local money gets stronger, we call that appreciation. Think of it this way. You need less of your cash to buy that foreign currency. On the other hand, when it gets weaker, that's called depreciation, and now you need more of your money for the same amount. Let's stick with our example. For appreciation, imagine the shekel strengthens. Suddenly, that $1 doesn't cost 3.65 shekels anymore. Maybe it only costs 3.00. See? You need fewer shekels to buy that same exact dollar. Your money just got more powerful. And you guessed it, depreciation is the exact opposite. If the shekel weakens, that rate might jump up to 4.00. Now it takes more shekels to get your hands on that same single US dollar. Your currency is weaker, at least when compared to the dollar. Okay, so we get it. Currencies go up, they go down. But the next logical question is, by how much? Let's get practical and look at a real-world example to see how you can actually calculate this stuff. So let's look at 2023. At the very beginning of the year, $1 would have cost you 3.67 shekels. Fast forward to the end of the year, and that same dollar now costs 3.82 shekels. Right away, you can see it's taking more shekels to buy a dollar. So we already know the direction, right? The shekel depreciated. But by exactly how much? What's the percentage? Well, there's a really simple formula we can use to nail down that exact nominal change. And here it is. This is our key. You take the new rate and you divide it by the old rate. Then you subtract 1. That little step is what isolates the change itself. And finally, you multiply the whole thing by 100 to turn it into a nice, easy-to-understand percentage. So let's just plug in the numbers from our 2023 example. We take the new rate, 3.82, and divide it by the old one, 3.67. That gives us about 1.0408. Now, subtract 1, and we're left with 0.0408. Multiply that by 100, and we've got our answer. And there it is, a positive 4.08%. So what does that tell us? It tells us the Israeli shekel had a nominal depreciation of 4.08% against the dollar in 2023. That positive number is the key. It confirms the currency got weaker. Okay, that's pretty cool, right? But hang on a second. Knowing this number is great, but it's really just one piece of a much, much bigger puzzle. There's another layer to all of this that we absolutely have to talk about. So, is the nominal exchange rate the whole story? The answer is not even close. And this is where we get to a really important idea that adds a whole new dimension to what a currency's value truly means. You see, everything we've looked at so far is the nominal exchange rate. It's just currency versus currency. But the real exchange rate? Now that's different. It tries to answer a much more practical question. Okay, but what can my money actually buy over there? And to answer that, you have to bring in one huge factor, inflation. This is what it's all about, really. The real rate is what tells you about your true purchasing power. It helps you understand if that vacation or that laptop from overseas is actually getting cheaper or more expensive for you once you account for price changes in both countries. At the end of the day, this is what really matters to your wallet. And that leaves us with this really powerful idea to chew on. How does inflation completely change the game for the real power of your money abroad? Think about it.
A currency could look like it's getting weaker, but if inflation is skyrocketing in the other country, your weaker money might actually buy you more stuff than it did before. It's the perfect reminder that in the world of economics, the first number you see is almost never the whole story.